SarahGennie, welcome to the show. Good to see you.
Thanks, Daniel. Good to see you. you.
I am looking forward to the conversation. And you and I had the chance to meet one another at the National Charter Schools Conference. And you actually gave a presentation on this topic. So I'm super excited to bring this to the masses, so to speak, who didn't get the chance to be there live. But before we dive in, why don't you give us a quick background on yourself, your role, and Windsor Charter Academy?
Sure. So I've been involved with charter schools since 2004. I'm a founding member of New Vision Charter School in Loveland. And then I got into that because I wanted to bring school of choice. We shop for shoes, we shop for a car, we shop for a house, we shop for carpet. We should shop for a school that best fits our students' needs. And so I wanted to bring more of like a Montessori public education because, $30 to $50,000 a year paying for education like that is out of reach of most people. It was out of my reach. And so that's why I joined that group who is bringing this first charter school in Thompson School District to Loveland, Colorado. And then I've been involved with several other charter schools since then and ended up at a full-time job at Windsor Charter Academy about 10 years ago. And our focus is we're a core knowledge school K through 6, and then we branch off into like a STEM focus for the middle school and high school years. And then also at Windsor Charter, our kiddos can get their associate's degree because we partner with Ames and Front Range Community College, so they can get a 2-year degree for free as they get their high school diploma. So that saves parents a lot of money for the first 2 years of college, which is also financially advantageous, and which is all my thing because I'm the director of finance and HR. And our school has been, so Windsor Charter Academy has been around since 2001. So we're celebrating our 24th year this year
Wow,
and 25 years in business next year, which is fantastic. So
that's phenomenal.
super exciting.
Love it. Well, you mentioned you have the unique privilege of covering finance and HR. Not the case at every school, but a lot of our smaller charter schools, you see this where maybe a CFO is also the head of HR or COO handles a number of different things. And so I'm guessing there's a lot of listeners who can relate to having to wear multiple hats. And today we're going to be talking specifically about employee health benefits and health insurance. And health insurance kind of sits right at the intersection of those two roles. One of your largest expenses and also critical to your employee value prop. So tell us a little bit about what prompted you to go down the rabbit hole of employee health insurance. And that's going to be our topic is going to be really kind of a case study exploration of Windsor Charter's experience with health benefits. And so I'm excited to unpack this with you. But let's start with just like what was the impetus to get you interested in really trying to make changes here?
Well, as you said, salaries and benefits typically make up between 68 to 73% of a school's budget. So that's a huge amount, and we can't really do anything about para because they take 21.4% of our salary and benefits section. But the health insurance was a big chunk because I was thinking about why we have to buy it in a certain way and what choices do we have. And our broker, I've known our broker for a long time. And there was always a conversation of, "Hey, I want to explore this alternative model of health insurance." And we've been talking about it for a long time, probably about 9 years. And it started to actually become a reality probably about 7 years ago. And the idea just like, okay, a charter school could control some of its cost because anytime we just pay a blanket amount to somebody, but we don't have any choice in how it gets allocated, do we have a lot of claims? Do we not have a lot of claims? And it's just, I'm giving them a huge chunk of our budget, whether we use it or not. And having the alternative, it's like, okay, wait a minute. If we don't use it, we could keep the money. That was incredibly appealing. And so that's when we started going, okay, how does this actually work? How much risk is the charter school going to take on? Because if we did it, I wanted to be able to share it with other schools as well, but it had to be a balanced risk. Like there had to be that balance between safety and also being able to keep our money, whether we ran well or not.
You
So that
mentioned
was what prompted the conversation of like, okay, how can we make this a reality?
hmm, you mentioned your broker kind of poking you about this for 9
Yeah.
years. What sort of was the tipping point for you to say, "Okay, now's the time for me to look at at other options? You mentioned like under your current model, you're paying
Mhm.
essentially a blanket sum amount of money. Were costs getting kind of untenable? Were you thinking about growth in the organization? And so it was just time to reevaluate what you were offering to employees? Like what kind of made you say, okay, Mr. Broker, it's time. Let's talk about this.
That it actually became a reality. So the idea had been talked about, like, okay, we think we can do this. We think we can do this. Let's put together this model. And then the year came when he said, okay, I've got it together. Do you want to jump in? And I was like, yes, me, us, we're going to do it. We're the first ones. Because when you have a cost like that, that's so out of your control, and you're seeing 5% increases one year, 12% increases the next year, they never go down mysteriously. So
Mysteriously,
while
yeah, isn't that
yes,
crazy?
mysteriously, it's kind of like, how did the price of eggs go from $3 to $9? And it's coming back down. But health insurance costs are not coming back down. So that was incredibly frustrating to be like, okay, we are not having high cancer rates, high health rate, diabetes, a lot of the things that plague other industries. Our main thing is pregnancies, right? We've got a lot of people having babies, and those can be high risk and sometimes they're not. And I mean, it's a normal thing that happens, right? And that's our business. We need kiddos. So I wanted to know, like, how do we control our particular population? And we could. And so the impetus that jumped us into this was actually having the captive model become a reality. And so, yes, we were gonna be the guinea pig of how it ran.
Okay, so I want to talk more about this captive model that became available, and we can talk a little bit about the difference between a fully insured model versus a self-funded model or a partially self-funded model. But before we kind of go down the insurance path, talk to me a little bit about the alternatives for you as the head of finance when you're looking at things like a 12% or 15% increase. Like what's the ripple effect, or how do you manage that when you don't feel like you have an option to address the benefits cost? Like let's say you're going to eat that no matter what, because I want to talk about some of the options that you all have been able to reintroduce with freed up funds. But
Mhm.
in the past, over that 9-year period, when you did get hit with a big premium hike, what was the ripple effect for the organization?
Well, it wasn't just Windsor Charter, it was the other schools I was working with too. So when we're trying to take on, between a 6% and I mean, I think the highest I saw was an 18% over different schools. What's your option? I mean, you can't continually absorb that when PPR, the per pupil revenue is only increasing by maybe 5% in a good year. And then, everyone knows in 2008, 9, we had those big rescissions, and we might be looking at something like that now, which is scary. But you can't just absorb everything. We can't be all things to all people. And so, unfortunately, what do you do? Do you freeze pays, salaries? Do you freeze benefits? Do you cut benefits? Do you do layoffs? That was something that we didn't want to do. And when you have high increases, you have to pass on some costs to the employees, and then they don't like that because it takes their overall compensation and reduces it. So basically, you're
Right.
hitting them with a pay cut. It's like, okay, sorry, I went from supporting you 100% at your employee plus children contribution to now $1,000 a month. Granted, it's pre-tax, but that doesn't feel good. And so, what were our options? Cutting benefits, passing the the benefit costs onto the employees, and all of those felt bad. So it was like, wait a minute, there is another option. Let's look at it and let's see how we can do it. Because I don't like being told no. Charter schools don't like being told no. I
That's
mean, that's
right.
why we formed in the first place, when it's like, sorry, we don't have the educational opportunity we want in this particular model of district, who are also trying to do the best they can with the resources that they have. And we just want to have less red tape. That's why charters are great, because it's like we don't have to go through a lot of the things that the districts do. And this was one of the ways. It's like, okay, we're smaller. We have some more flexibility and risk tolerance, as long as we can educate our board and, my finance committee essentially, and say, okay, this is a wise choice and here's why. And so that's when we started digging into the numbers. The captive model again became available to us because you have to hit a certain number of lives in the program to be able to participate in it. And so when that It was just like all the things kind of lined up together, sort of like when people put a charter school together. It's a lot of work laying the groundwork. You got to get the buy-in. You got to create this 800-page application. You have to pick your curriculum. You have to pick your budget. You got to find a facility. So all of those things lined up in place to start a charter school. And then it did the same way for health insurance. So that's why we were like, okay, let's look at this. So that's how we probably should get into talking about the fully insured
It's
model versus
perfect.
captive model.
Yep. That's the perfect transition. Okay, so disclaimer here: SarahGennie and I are not insurance brokers.
Correct.
SarahGennie knows a lot more about insurance than I do. So, but we're going to throw that disclaimer out there. Don't
Mhm.
we're coming at this from the school perspective, not from the insurance side of things.
Correct.
But I think you're the perfect person to explain this because you went down this path of curiosity and exploring these models, and I think you'll be able to translate the other language that is finance speak or insurance speak, where acronyms get thrown around and things like that.
Mhm.
Can you just break down for us, like act like I'm a fourth grader and explain a fully insured model that like most average small charter schools are using today?
Sure. And I'm going to use English because I do not like it. Acronyms, I don't understand most of them. And so this is, again, my interpretation of how a fully insured model works. And I'm not an insurance expert. I just want to know I want to know where my money goes. So here's the thing. In a fully insured model, you are buying a policy that says, okay, insurance company is going to take on all the risk for whether you have an employee who is healthy and just goes for their well person exams, their vaccinations, all of those normal annual things, or you have someone who's incredibly sick that needs extreme amounts of prescription medications and care that requires doctor intervention type thing. That's what the fully insured model protects you from. So you basically pay for the network, the administrative use, the claim management, the claim payments. There's no surprises. You just pay that per employee per month premium. So let's say it's $1,000 per employee per month. So it's $12,000 per employee per year for their medical insurance. There you go. And if you have $1 million worth of claims, great. Your policy, covered that. And if you have zero claims, well, you just gave the insurance company a really good year and they just made lots of money on you, which that's where I started going, I don't like that at all. Okay. So do you want me to transition into where the captive piece goes or to the self-funded piece?
Let's do self-funded. So let's look at the other side. So that's fully insured. You pay
Hmm.
your flat rate. It's great for your Excel model. You're
Yeah.
covered. You're covered either way. Give us the inverse. What's the self-funded model?
So it's kind of a transition. So the self-funded model, you still are buying a policy. Okay. But what happens is the charter school is actually taking on some of the risks. So, like a personal, let's liken it to auto insurance, right? Where you get to pick your deductible. Some people are like, okay, I have $100,000 worth of insurance and I only want a $500 deductible. You can do the same thing in a self-funded model where you're like, okay, we'll take on $45,000 per employee per year of risk. And then the insurance company will take the rest of it because you always have some sort of protection that's called like a stop loss protection level. So that's what the self-funded is. And that gives you kind of like this bucket where we are responsible based on actuarial data and all the insurance company calculations. Like, okay, this is your age population. This is your male, female demographic. This is the estimate of what we're going to say your expected medical claims liability would be versus your maximum. I personally don't budget at maximum liability because we've never actually hit that as a charter school in the past 6 years we've been in this plan. So I usually take expected, and then we have a little bit of buffer in our fund balance to accommodate for if we had a really bad year of claims. So in that self-funded plan, we're taking on that risk up to the $45,000 deductible level per employee. And that's where the beauty kind of comes in because if you run well and you only have one NICU baby, you get to keep all that stuff, the money that you didn't pay in medical claims, which is huge for a charter school because if we're budgeting, let's say I budgeted $1 million for health insurance, but in this self-funded model, we only paid, I don't know, $350,000 in claims outside of the stop loss piece. we get to keep that excess. That goes back into our bottom line, which can help us build up a healthy reserve for future use or to use in other programs. And that's how I think we can transition maybe into like the captive model, which gives an additional layer. And we can talk about the savings that Windsor Charter has had from 2019 to 2025.
Yeah, let's go there next. So, just to recap, fully insured, you're paying your rate per employee no matter what. Doesn't matter if you have the world's healthiest employees.
Mhm,
In the self-funded model, you're explaining that there's actually more customization there. You can select
mhm.
a kind of a deductible, and it really depends on the actual medical costs that your employees are incurring. And you mentioned this earlier, and I'm guessing this is true for other charter schools too. Your actual population of employees is a little bit on the younger side. They're having babies. They're not dealing with, acute care that may be more common later in life. And so your overall kind of medical risk or bills associated is potentially lower than that kind of per employee rate that you would be paying in the fully insured model. Did I get that right?
Mhm. Yes. And we have had, and I can get into that later, but we've had a terminal cancer claim, and we've had some really serious health issues for people that are in participating in our plan and have experienced some high cost years. So we've kind of in the 6 years we've been participating in this, we've had really low ones and we've had some really spiked claims too. And overall, when you average all that out, we have still saved a lot of money by using this particular plan.
Got
And
it.
the other thing I know that you're going to talk about later that is that in the fully insured model too, you basically buy prepackaged plans that the insurance company has. But then when you create our own in the self-funded model, we had the opportunity to go through and really dive down line by line by line of what health insurance offerings we wanted to have. And so that's also the beauty of it is which I didn't understand when I first was just looking at money, right? I was like, okay, I just want to really save money. But then we got into like how do really you create a health insurance plan that your employees want and need, and that was what one of my colleagues Nora presented at the charter school conference was that they really dived into that as well and did some incredible surveys of what employees need based on your demographics, and so did we when we started building our actual health insurance plans that we offered, and I'm happy to
Okay.
talk those specifics later.
Yeah, yeah, I wanted to get yeah, I definitely wanna come back to that idea of being able to customize the plan for employees. Before we go there, talk to us about a captive. So what's a captive? How does it impact risk? Because I'm sure for other finance folks who might be listening to this, when they hear things like we had some years where we had some really significant claims, they're
Yeah.
probably immediately thinking, "Oh gosh, here comes the like, this is too good to be true. Here
Here's
comes
the
the"
hammer.
That's right, "Here comes the hammer." So talk to us about the captive and sort of risk in general as it
Okay.
relates to a self-funded model.
So in the captive, basically, you still have several layers of how you of I guess cost strategy. There's the fixed cost. So there's always going to be a fixed cost portion that you pay what we call a third party administrator. And I'm just kind of looking over here because we have a slide and I'm not sure if you're going to like post that at some point, but
Yeah,
it's
we'll link
helpful
to
like
it. We'll link to it in the
yeah,
show
a
notes.
visual is really helpful because you have to buy a network, right? Whether you're through Cigna or Aetna or United Healthcare, you're essentially purchasing their website access, their doctor list, the practitioners, whether you want to go to hospitals for certain care or standalone clinics for MRIs, x-rays, things like that. So your fixed cost includes buying access to that network, the website, and then their payments of your thing. So I didn't want to become my own third party administrator where I was like reviewing every check and writing all of that. That doesn't make sense. So that's part of the fixed cost that we pay for is that administration piece of it, the evaluation of the checks, issuing those things. And then once you're in a captive, you still have the deductible that you purchase per employee per year. That's the claims liability where it's like we're taking on a certain amount of that for all of our employees for the 12-month period. And that's where we have a big chunk of savings is like, okay, did we actually pay all those claims out or do we get and we keep all the money? It's not something that we pay the insurance company and then get back at the end of the year. We are actually the ones who are having the health insurance checking account where all of these claims are being paid out of. So you want to set up a separate checking account because you don't want that in your general fund checking account. Then what the captive layer does is it takes similar school, because we're all charter schools, so we're not participating with attorneys, we're not having construction companies in our firm, in our captive, any of that. It's all charter schools together. And so we have very similar demographics. And that's where you share a layer of risk. It's like, okay, we're gambling on ourselves, or we're going to have certain claims within a certain bandwidth. And so we're all going to contribute a certain chunk to this pool. And then at the end of the year, based on how everybody runs, you can get money back or not, depending on how the pool runs. So we still keep our claims liability to ourselves, but then that higher chunk where we say, okay, we're going to share risk among these increased claims, that's where sometimes the funds come back and sometimes they don't. I think we've had one year where we didn't get a lot back because we had some high risk claims. And then after that, everybody shares what they call the reinsurance pool, where the insurance company comes in and says, okay, at this layer, we're going to take on all the liability for super high risk claims. So we have our own like stop loss deductible, and then we have a shared portion, and then the risk is transferred. So you still buy the reinsurance premium for that, because no one wants to get hit with a $5 million. I mean, no one can afford that. So
Right.
the captive never means that the charter schools as a group are taking on 100%. That's not what it means. It just means that we're just sharing risk because we feel like our demographics have overall lower health insurance claims. And so it allows us two sections, if you will, in the visual of ability to get money back or to save money overall.
So make this practical for us or tangible. Can you share some actual financials around this? You mentioned you guys have been in this captive program for, I think you said 6 years now. There's your own. You mentioned there's sort of different layers of the cake, so to speak, and certain portions of that you can get back depending on how the year goes. Talk us through some of the actual financials, like where did those savings come from? Make it tangible for us.
Sure. And if you'll also share like our annual history, Windsor Charter, we put together our employees per month, and then what our admin fees were, what our stop loss premium was, our budgeted claims, and our actual claims. And so over the 6 years, so I have data from 2019 to 2024. And our per employee per month cost went from $731 per employee per month in 2009 to $750 per employee per month in 2024. So that's
Wow.
not a big change. Okay.
Yeah.
And we did see, so it went from 731 to in 2019 to 685 in 2020. And then we had a big jump in 2021 because that 2020 year was one of our bad years. And so it went to 805 per employee per month. And then it went to 845, and then it dropped to 799. And now we're back down to 750. Where in the fully insured model have you ever seen your per employee per month cost drop?
Right. Yeah, that doesn't sound like 12% year over year.
No, it's not. And so it's like we have our change over time as well. And the reason that we did the per employee per month in our graph was because that's what we want to show people, because we've continued to increase in student enrollment and employee enrollment. So as far as aggregate total, it didn't make sense because you would see the increase overall.
Right, right. You
But
need
the
the
per
context.
employee per month cost, that is what has fluctuated a little bit based on our need, and our claims data actually gone down. And so we're really remaining in a stable position overall. So when you actually have the chance to like look at our data, you can see the captive layer surplus returns that we had. And so, and our claims data. And so that's what, when people actually pull up this graph and look at our history, I want them to be look at our budgeted claims line item and our actual claims line item, because in 2019 we budgeted $444,000 of actual claims, right? And remember, that's not my total medical insurance budget line item. We have fixed costs that we have to deal with, the third party cost. So
Right.
but these were the claims data is what's important. Our actual claims in 2019 were 435,000. So we had a savings of $9,000 right there. Okay, even though we actually ran pretty high that year. In 2020, from, because you have to, again, we're on a fiscal year basis and this is kind of on a calendar year basis, but we had budgeted about $515,000 of claims and we spent 399. So there's
Wow.
another savings that, okay, all of that money stayed within the school. We never paid it out. The insurance company just didn't get to keep it and make a profit on us. And then you can see on the bottom layer where we had captive layer surplus. So remember, there's that other layer of the cake where you've got, the white and then the chocolate, and then we'll put the raspberry up there.
Yep.
Okay. The raspberry is like that layer where we are sharing the risk. Okay? And it could be really sweet, but it could also be really bitter and then we're sad if we had a bad year.
There could be mold on the raspberry. Yeah.
So that year in 2020, we actually ran well, but we also didn't get a lot of captive layer surplus returns because I think everyone was kind of running really lean that year and had as a risk. In 2021, where we had that big jump in per employee per month cost, that was a reflection of all of those high cost claimants, and we didn't get any money back that year from the captive layer surplus. And we actually ran over our budgeted claims. But that's where, when you have those savings years, you don't take that medical savings and just be like, yay, we're going to spend it and we're just going to go buy
Right.
all the things, right? And this is the year we get a Maserati. No, you know that health costs change and people's lives change, and we have things that happen to us. Your kid breaks a leg, you break your leg, you have rotator cuff surgery, you have 3 NICU babies, all those things. So those savings need to go into a reserve fund that's designated for those years when you exceed your expected, because then you don't have a problem with it. And then the great years you save up, and then the lean years or the negative years you have the money to care for your employees. And you don't spike your budget either, because we can't run on the maximum claims all the time, because then that's just not how things go. So, and then for the next several years, we ended up with captive layer surplus returns, 161,000 one year, 218,000 the next year, and then another 100,000.
Wow.
So that's
So what's
amazing.
the total, like, over the 6 years? What did the total end up being in terms of combined captive surplus plus your Windsor claim surplus?
So overall, when you look at the 6 years between 2019 and 2024, we saved $744,000 in claims. So
Wow.
that went into our reserves. And
Mhm.
then our captive layer surplus returns were $593,562. And then of course, you get prescription rebates as well. So between those 2 layers of the cake, we saved $1.4 million over 6 years that went into our reserves.
Okay, so $1.4 million, that's really significant money. And
Mhm.
presumably, just to give people some context, how big is Windsor in terms of enrollment in schools? Just so people who are thinking, okay,
Mhm.
what's my proxy for my school?
Right. So we right now have about 1,600 students, and I have 188 employees and 163 benefit eligible employees. And back in 2019, we had um, 95 benefit eligible employees. So
Got it.
we've grown significantly over time. And I want to say in 2019, our student population was right about 900, maybe 1,000.
Okay, so
Um,
you guys are right in that 1,000 to 1,500 plus range on the enrollment side,
yeah.
and 100 to 200 on the benefit eligible FTEs.
Yeah.
So 1.4 million dollars is a lot of money, especially given your size.
Yep.
That's significant surplus. You mentioned this goes into reserves. You don't
Mhm.
pull that cash out and buy new school buses or returf the football field or whatever it is. But what did you do with the money? Like, is that just sitting in a bank account waiting for a potential fluctuation in your health costs, or are there other things that you're able to pull off? you know, I don't know, I keep going back to the cake analogy. Additional icing that you can then scoop onto employees' slice of cake. Like, help me. The analogy is terrible, but help me understand. Like, are there other kinds of programs and things you all have been able to implement because of this new approach to health benefits that's been beneficial to your overall kind of employee value?
So I like the idea of adding icing, but icing is um, it has no nutrition, right? So let's add some protein. Let's put a little
Protein, I
collagen
like
powder
it.
in that
Yes, a
cake,
chicken
okay?
breast on top of your
Yeah, let's make it richer. Let's make it denser. Let's make it more healthy. That's absolutely right. So we did all those things. So yes, we put some money into a restricted reserve to cover those scary years. Okay. Let's just be wise. Let's be real that you're going to have it. Okay. So if you go self-funded, if you jump into a captive, you need to be wise. You need to have your board be prepared for it. Have your broker come and do the financial analysis. Okay. Or just really have an in-depth analysis of your demographics. So we set aside $800,000 into our medical emergency fund. Okay. And then we budget at expected liability, not maximum. Then we also, in order to make that cake a little bit richer, a little bit denser, we decided to enhance our benefit offerings with IVF. So
oh, wow.
as we know that nationwide, worldwide, populations are decreasing, right? Birth rates are going down. Every charter school conference you attend, there's a demographics presentation about
Mhm.
where are the children?
Right.
People aren't having kids. In Windsor, the average price of a new home is $500,000. Even if you're a two income earner family, you're coming in and you're maybe starting $50,000 as a teacher. That's a really hard pill to swallow. I don't know how people can afford to come up with $500,000 in a mortgage. So it's expensive. And then, kiddos, all of the things. So we wanted to make sure that we drew people in. And with people having problems getting pregnant now, young people, IVF was a big thing. And so
Mhm.
we added that. And so I think we started this first year with like a one round payment of the IVF treatments. And this year, going into our 2026 benefit year, we're going to increase it to 2 because it
Wow.
typically takes more than one time for people to get pregnant. And it's really hard. It's really stressful. We don't want to add that to our teachers. And if we can help them by paying for that, plus it's our business, right? If we want an enrollment and we want to get people locked in to Windsor Charter Academy for life. And if this is the way we can do it, we're going to do that.
And
Another fee.
IVF, for people that don't know, IVF is like a ten to $20,000
Yeah.
process. I mean, this is a really this is not like a $500 addition to your your overall package. This is thousands and thousands of dollars for those who haven't, are less familiar with IVF. So I just wanted to throw that in there.
Thank you. Yeah, no, it's perfect. So we actually did $20,000 this first year, and we increased it to 45 for our
Wow.
2026 year. Just because we've had experience with our staff struggling with this, and when we told them that, we had 3 people just break down in tears in our on
Mm.
our audience in our benefit presentation because they were just really grateful and they want to have a child and they should be able to. And so we want to be able to support them in any way. Another way we customized our plan was by adding hearing aids. So people who have experience with that in a fully insured model that just kind of has like that package, here's what you get. Hearing aids are very rarely covered. And we have several people in our demographic also who alerted us to that. And we thought, that's ridiculous. This is like a critical skill that we need to have. So our plan is going to
This
cover
is one of
hearing
the
aids.
five senses. Come on.
Right. And we have an ASL program at our school. We have several teachers and substitutes who are hearing impaired. And so it's amazing how the world is not set up for people who have visual disabilities, who have hearing disabilities, who have mobility disabilities. And we've been so fortunate and blessed to have people in our school who have brought that to our attention. And so, like, we've got several cheerleaders who are mobility impaired, and 2 of them are in wheelchairs, and they're on our cheerleading team. And so we've made those accommodations for that because it brings richness, it brings depth to everyone's experience in the school, and it brings awareness. And
Mm.
so that was one of the things that was really amazing about us being able to customize our plan as well by going to this captive and this self-insured model where we're like line item by line item, IVF, hearing aids, acupuncture, chiropractic, all of the things that bring us into a more cohesive, healthy way of living. We want those in our plan. I don't want all of my people, and I say that my people because that's how I feel about them. Like all of our employees, I want to be as protective of them as possible. And if these things help them stay healthier without prescription drugs, then that's what we need to do because we can't just drug people and say that's the healthy way of living. That's not. If you can use acupuncture, chiropractic, hearing aids, all of these things to have a healthy life, let's do it. So, because it's
And
going
so
to keep
that and so that really changes, or I guess, you know, from your perspective, do you feel like you've seen the tangible difference in retention around staff? Because I would think, I'm a former teacher in the landscape of teaching, like the variance in salary is only so much. And so it becomes about, is it a culture fit? Do I like the people? Is it where I live? But that's really changing like the overall value that a potential staff member is getting. Have you seen positive impacts on your employee retention or even your ability to recruit young staff that might say, wow, they're being really thoughtful in their benefits package? Do you all
Mhm.
have any data on that, or is that still kind of playing out?
It's still playing out. We're tracking it, but last year we got 2 teachers who had, a $6,000 variance in salary offerings, between 2 different schools, and because we offered IVF and the other schools didn't, they chose our school.
Wow.
And then I wanna keep going because it's like the other thing we did to enhance our plan was we brought on a full mental health program. And so most schools are able to buy through, like, their long-term disability insurance company or whatever it is, like an EAP, the Employee Assistance Program, that might offer, like, 3 to 5 mental health visits. Well, as a human, life is really complicated on this planet, and it's getting more and more stressful, and everyone who went through COVID will attest to that too. Like, that just brought a whole new layer of complexity to how we function in our world. And the kiddos who are coming into that now, all of our teachers who we need to be completely, like, I want to say, like, aligned, full, balanced human beings. Not only were they struggling with their own lives and families and kiddos, but now they're taking on 26 of everyone else's kiddos who are kind of coming back in and just with life. And so the full mental health program, we pay about $7 per employee per month. It is complete therapy. It's on call, like it's virtual, which is the beauty of it because you can take your lunch hour and do your counseling appointment or whatever it is
Right.
you want to do and then go back to work and hopefully feel like, yay, okay, that was a relief, or oh, that was really heavy. Maybe I should do it after work next time. But you don't have to drive 45 minutes to an appointment. You don't have to wait
Right.
3 weeks to get in with a therapist. This program that we purchased for our employees is both counselors, mental health coaches, and a psychiatrist. So they can prescribe medication as well, which is fantastic. And they do couples therapy, grief therapy. There was one counselor that I found online looking through all of the bios who does hypnotherapy, who does ketamine therapy, all of the things that people are interested in now to open up their minds and become more healthy. This program does it. And it's unlimited support, it's unlimited visits for unlimited reasons for our employees and all their family members. So
Wow.
that's what I love about it, and we have an incredibly high utilization rate right
I
now.
was just gonna ask. I wondered how high the utilization was because I feel like that's always the knock on these programs. It's like, great, you tagged on these programs and then nobody uses them, but it
Last
sounds
month
like that's not been the case.
was 67%.
Yeah, that's incredible.
Yes, and the cool thing about is I don't see who is using it or
Sure.
any of that detail because that's protected, that's
Yeah.
private information, and so the only reason that an employee would reach out to me is if they're like, "Okay, the app isn't working. What's this link?" And then I can just say, "Okay, let me help you walk through this and get you set up with the correct piece of it and all of it." And they're all Colorado licensed practitioners as well, which is wonderful. And I have not run into any issue where the person actually couldn't get in the exact same day or within 24 hours. There is no waiting time. So that's fantastic. Because when you're going through something and you're reaching out for this, you want to be able to talk to somebody right away. And this
Right.
program has been fantastic. So that was the thing, another thing we added to the richness of our cake and our benefit offerings. And then one other piece we did was brought in-house short-term disability, which is we do not pay an insurance company for our short-term disability program. We fund it in-house. And so if an employee has to go out for having a baby and that does physically disable you for a certain period of time, and then or have just rotator cuff surgery, knee surgery, a hip replacement, we pay 100% of their salary for the first 55 days of their disablement period, and that's after that was when long-term disability would kick in. But most short-term disability policies only pay 60%. So this was really well received as well. You know, having our and so basically what that bucket does in our budget is pay for the substitutes. Because you've already
Mm,
budgeted for 100% of the employee's salary anyway, right?
right, right.
You're
Those
just
funds are
while that
there.
person's
Yeah.
gone, you need to pay another person to come in and fill the hole. Might as well
Mhm.
just pay that person, 100%, keep them on, make them feel cared for, protected, all of those things. It's like, and they're not going to have that huge salary drop because that's hard when you go out for a medical disability. Even just having that baby for 6 to 8 weeks and then having your salary cut, that's that's not
Yeah, it
good.
doesn't make sense.
No,
Yeah.
so we just took a lot of that risk, brought it in-house. And so, yes, we have data for that too. That program is actually really well received for all of those things, and we're paying for the substitutes out of that pot of money.
Love it. Okay, so let's come to a close here. We've talked about, all of the things that moving to this self-funded captive model has allowed you all to do, freeing up additional funds,
Mhm.
allowing you to do all the things you were talking about, IVF, mental health on demand, bringing short-term disability in-house.
And retention, I forgot that. So I hope you're gonna close up with that.
Give us the 1 minute on
Yeah.
retention.
Okay. So the other thing we did was we put a retention bonus program into place. And the reason that I did this is because this is actually excludable from the state defined the pension plan, okay? And so we want people to stay. Again, that's why we're trying to build these programs is we want to get these teachers in line. We want them for 20 years and we want them to retire with us. And so how we put together is we have milestones at 2, 3, 5, 8 years, 11 years, 15 and 20. And our retention bonus goes from $2,500 at the 2 years. So you spend 2 years with us, you return for your third year, you get half of that 2,500 bucks. And we did it in November because, of course, we know people want to have the money to spend for holidays and things like
Yep.
that. And in May, okay, so that we keep them for that third year. And then at our 20-year mark, which we have someone getting this year, is $13,500. And so they'll get half of that in November and half of that in May, which
That's
is
awesome.
fantastic. And that actually has retained people because they're like, okay, we've been here 2 years, but if I leave on my third year, I missed that bonus. And
Mm,
so they stay and they stay with us. And we this year in our welcome back party for all of our employees, we had one employee celebrating her 21st year with us, and then another employee celebrating her 20th year with us.
man,
And so
that's
that
so
just
cool.
feels really good.
Yeah, and so cool to be able to tell other staff, like, they're getting this big bonus and, we value their tenure here.
And we
Um,
usually we usually split it too, so it's like because when you combine a bonus and someone's main monthly salary, it raises their tax brackets, and
right,
so
right.
what we do is we're like, "Okay, no, 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 keep your monthly salary, let's put this one in a separate check,
Smart.
reduce your tax bracket." We don't want the government to have any more money than they should.
Leave it to the people. Yep, I'm with you there. I'm with you there. Okay, so I'm glad we hit on that because that's a really big deal, and I know a lot of organizations have tried to think through. We want to
Mhm.
do a retention bonus plan, but how do we fund it, and how do we structure it? We could do a whole episode on that.
Yeah.
Um, but for others who are listening to this and they're saying, okay, we're in a fully insured plan. We've had the same insurance set up for 10 years. Where do we start? Like what's the first step? If I'm, a board member, a CEO, a CFO, talent manager, and I'm thinking, man, this sounds great. We'd love to be able to offer those things to our employees. And I know we're in a fully insured plan. Where would you recommend people start the education process? And any kind of personal learnings as you reflect on this journey that you would share for other leaders?
Start talking to your broker. So if you're the finance person, work with your HR person as well because it's a true collaboration, but start asking questions of your broker. Is there a self-funded option within your brokerage plan? Is there a captive that we could join? And if they say no or you get shut down, find a different broker. Okay? Your questions are good. Questions are how charter schools got started. That is a cornerstone of our creative philosophy. And if anyone is shutting you down, then you move on to the next one because they are experts in their field. I'm not an expert in my field. I ask a lot of questions. I am probably one of my broker's most challenging clients because I will always be like, okay, why are you telling me this? How does this benefit my employees? Is it going to add to or is it going to detract from our overall bottom line? Because that's where I want to end up in the black, but I also need to balance, the HR and the finance. And I believe there's no conflict there. We always can exist in balance. We just have to work together to figure it out. So talk to your broker. If you are not getting answers, again, find someone else. Reach out to other charter school leaders. Email me, email Nora, reach out to Daniel. He'll put you in contact with people who have those resources. And then it's not that hard. It is a lot of asking questions. It is a lot of educating yourself. And then once you get the idea of it, be like, okay, how would this work for my school? Can I convince my finance committee? Bring your broker who you're partnering with to talk to your board. Our board every year has a presentation from our broker who says, and it's one of their favorite presentations, and he just educates them every year on what a self-funded insurance model is. And it's one of our board members' favorite presentations every year is because our broker is entertaining. He speaks English and he can really bring it to an understandable format for all of our board members. And we have one who's really good at finance and most of their other ones have expertise in other areas. And it's a partnership. Like all of us work together to collaborate to bring these balance to this model. And this is just one way of doing it. And I'm just super big on the education and I want everyone to have that buy-in.
Love it. Okay, awesome. Well, that's a perfect place to come to a close. And quick shout out to Gary Clark over at Hub, who is SarahGennie's broker. Gary and the Hub Charter Practice, they work with charter schools all across the country. BuyQ, our organization, happens to have a program with Hub, and we've worked with them for a long time. And so if you call us asking who to talk to, we're going to send you to Gary as well. And they do a great job. So if you are looking for a broker who's willing to talk to you, we'll give him a shout out and we'll link to their contact info in the show notes. SarahGennie, if fellow charter leaders have more questions for you or want to connect with you or want to learn more about Windsor Charter Academy, where should we send them?
Go to our website and reach out to me directly. Just email me. You're welcome to call me. I love talking about this stuff. It's fun, it's exciting, and it's just a way of thinking outside the box, which that's what we do. And so, it's like we've got the world who's trying to press us in with all of these things, and we just have to be like, no, thank you. I'm going to go that way.
Yep.
And we try something else.
A lot of that ethos is in the charter space. So it's awesome to see it applied to something like health insurance. SarahGennie, thanks again for coming on, for sharing your expertise and your experience. Really appreciate your time today.
Thanks, Daniel. Have a great day, everybody.
Thanks for listening to Charter School Insider. This show is brought to you by BuyQ, the group purchasing organization specifically for charter schools. Want to learn how to maximize your school's purchasing power? Join together with thousands of other charter schools by visiting buyq.org/sign-up. BuyQ's purchasing program is free and has no obligations or commitments required. If you enjoyed today's episode, do us a favor and subscribe on your podcast listening platform of choice. If you have a question or feedback for us, we'd love to hear from you. Send us an email at podcast@buyq.org. Thanks, and we hope you'll tune in for the next one.